Good evening, everyone. First things first, a warm welcome to one and all who is joining us on this wonderful evening. I would like to take this opportunity to wish everyone a happy 2020 and also happy Chinese New Year. 在此，小弟要跟大家拜个早年，祝大家新年快乐，身体健康，万事如意。With that, let's jump right in. So, ladies and gentlemen, what do we have here? What do we have here? Yes, banana. What else? Pisang, yes. Duct tape. Correct. So this is a duct tape banana. So how much would you pay me for this? So inside your head, how much would you pay me for this? That duct tape banana is actually a work of art. So that duct tape banana went for US dollar $120,000 at the Basel Art Fair in Miami in December of last year. Okay, you look at that duct tape banana and say, who would pay $120,000 US dollar for that duct tape banana? But the best part is, not one, but 3 of those duct tape bananas were sold. Anywhere between 90,000 pounds to 115,000 pounds for a duct tape banana. Right? So obviously a few key takeaways. The first one is obviously, I'm in the wrong line. Right? Second of all, how much money do you really need to have to be able to buy a duct tape banana for 120,000 US dollars? Right? So how does this duct tape banana relate to us all here in this room? Okay, you know the movies Sixth Sense? That movies that start Bruce Willis in late 1990, 2000, the little boy who sees dead people, and the famous line is, I see dead people, right? So ladies and gentlemen, I'd like to confess, I see duct tape bananas. And they talk to me as well, and they tell me scary stuff. So I would like to share that over the next few slides, and hopefully that will give us perspective of what is happening in the world right now. First, on my first slide, this is a slide of the market value of negative yielding bond in the world. So what does negative yielding bond means? That means the bonds are actually giving you a negative interest rate, which means if you give me $100, if you lend me $100, at the end of the day, I will give you back 99.95, which is below your capital. So that's not normal at all. Because typically, when I lend you money, I expect my capital back, and I also expect a little bit of interest, right? But in this world that we are living in right now, at its peak, there was 17 trillion US dollar worth of negative yielding bond. So what does that mean for us all, right? Important thing to note here is, there must be so much fear in the air that there are people out there who's willing to say, I'll lend you money, but I'll take back less than my capital. And it's not just one, it's not just 2. It's US dollars 17 trillion worth of investors who are willing to lend someone money and get back something less than in return. So that doesn't make sense at all. You ask your bankers, you ask the loan shark, no one is going to give you that deal. But that is really what is happening in the world right now. So for me, duct tape banana. Why is that happening? If you look at it, right now, all these negative yielding bonds are actually happening in quite a few places, mainly in the Scandinavian countries and also in Japan. In all these countries, especially in Switzerland, Germany, and Japan, just to take a few examples, all the bonds that are being sold by the government are actually yielding you a negative return. And that doesn't make sense on a few fronts. First of all, if we're going to push this to its logical conclusion, banks will be in serious trouble, insurance company will be in serious trouble, pension funds will be in serious trouble, right? And it doesn't make sense because there will not be any investment hurdle rate anymore because everything is negative. So what's the relationship between a borrower and a saver? Would you rather be a borrower or would you rather be a saver? As a borrower, you actually pay back less than what you borrowed. So once again, duct tape, banana, right? So on this chart here, what I have here is a simple chart of equity returns over a few key markets. US, Europe, Japan. The trend is clear, right? Everything is making all-time high as we speak. In the first case, in the duct tape banana negative yielding world, everybody is so fearful that they are willing to take back less of their capital. That's just essentially shoving money to the Japanese, Switzerland, German government and say, take my money. Just give me back something a little bit, something less than what I gave you is good enough. Because if I were to invest in something else, I might lose even more money, right? So essentially that's what the market is saying in the first chart. But on this chart here, you can smell the greed. Markets are making all-time highs. So who is right? Are the fixed income investors right or are the equity investors right? So once again, duct tape bananas. On this chart here, it's a bit complicated, but allow me to go through this chart. There are three sets of numbers here. The top set is essentially December of 2018. Second set is June of 2019. And the last set is December 2019. You can see two lines. The solid line is what we call the Fed dot plot, the solid line. So what does the Fed dot plot means? This line is essentially the average of all the FOMC members' view of the interest rate markets. So they survey all 12 of them, 14 of them, and ask them, where do you think the interest rates will be over the next few quarters and over the next few years? And that's important because the FOMC essentially are the guys who set the US interest rate. So one would expect they would know what the US interest rate should be over the next few quarters, since they are the wise men and wise women of US who sets the interest rate for all of us, right? So that is essentially the Fed dot plot. And then you have the dotted line here. So what is the dotted line? The dotted line is what we call the Fed fund futures. Essentially, it's what people like us, market participants, think the interest rate will be over the next few quarters and over the next few years. So if you look at December of 2018, right at the top, you can see the shape is totally off. The Fed dot plot, essentially the FOMC members are saying they will be hiking interest rates throughout 2019 and beyond, right? So the shape is moving up. But the Fed fund futures, which means people like us, last year when we were having this talk, the market was saying that no, the Federal Reserve will be cutting interest rates throughout 2019. And to me, that's a duct tape banana moment because, as I mentioned earlier, the FOMC are the ones who are setting interest rate. And yet their expectation or their view of the world is so different from what the market is expecting at that point in time, right? So how do we expect FOMC or the Fed to actually save us, right? But as the year grinds on for the entire 2019, you can see the shape started to change. Even the FOMC members themselves say that, you know what, by June of 2019, they say, you know what, I think we need to cut rates, right? And then the market is more or less saying the same thing. But December of 2019, which is just last month, we can see, right? At least the two lines are closer together. And that's important because as of end of last year, FOMC members were essentially on another planet. But at least now, in December 2019, we are at least on the same page. So that's why our view is that I think the market will be much less volatile because finally, the Fed, the market is more or less on the same page. So we don't expect to see major gyrations for this year. And that will have an impact on our investment going into 2020. So on this chart here, just 3 lines, essentially, US debt levels. US debt levels versus GDP. You can see 45 degrees lines going up, and that's since 2009, and that line continues to grow up at an increasing rate, right? What is significant here is this. From October of last year, the ECB, the Fed, have decided that they're going to do a stealth QE, right? So we can expect this line to even go even steeper because they have started to print more money, right, from October and November of last year. And the other worrisome thing is this. So if there's a Democrat president at the end of the year, I think this line will get even worse because if you look at some of the candidates, they are talking about socializing debt, right? Free healthcare, free college education. That would mean this line would have to go even more steeper, even steeper, right? So why is there a duct banana moment? Just look at the US interest rate. The US interest rates are at an all-time low, and yet the debt, be it you measure against the debt to GDP levels, is an all-time high. So once again, right? So this doesn't make sense to me at all. But this is the market that we are living in right now. So how does that all affect us? I think it's important to note that end of the day, right, in 2020, we are already in the 11th year of the longest bull market mankind has ever seen, right? I think we are already in extra time. If you use the football analogy, we are in extra time. Typically, extra time in football is 2 halves. But right now, we are in the 4th halves, right? We are making new rules as we go on, right? I'm not sure when the golden goal will come, but we're making new rules. Money is getting printed, we are pushing the end line further and further away. This chart here, this was my cover page for my second half 2019 outlook. I call this the Infinity War. So obviously you can see from the chart, I rip it off, Infinity War, right? So instead of the characters, we substitute it with my version of who are the key players in the market at that point in time. So obviously, Thanos, I feel, is Trump, right? With one snap of the fingers, he wants to change the world, correct? So rest, we have Xi Jinping, Boris, and everybody else, Iran and everybody else. So those guys were actually a concern to the market in the second half of 2019. So we fast forward to this chart now. So what is the scorecard? So I've made it easy for everyone. So green is good, yellow is not bad, red is not good at all, right? So let's start off with the green part. Brexit, Boris Johnson, it's a done deal. 12th December, the deed is done. We know he has overwhelming majority, right? So I think the market has moved on. Just look at the pound, right? Since the election day, the pound have gone from strength to strength. So our view is Brexit will no longer be a concern on the market from now on. Same thing for the Japan-Korea war. So that was a big issue last year. Because essentially, Japan refused to export sensitive tech materials to Korea. But that also has been resolved. Essentially, that was a politics issue that is resolved as we speak. And the next thing is Federal Reserve, like what I showed you in the chart earlier. My view is last year, everything was in a flux. The market was in a flux. FOMC was in a flux. So that created a lot of problem with the market. But this year, at least like I mentioned earlier, everybody's on the same page. So I think Federal Reserve will have less of an impact on the market in 2020. And that's a good thing. Chinese saying is, 越帮越忙, right? So it's best that they sort it out and we can move on. So let's talk about the orange part. Hong Kong protest is in orange. Even though we know that there's no resolution inside. But my view is this thing has gone on for 7-8 months, right? And if you look at the share price of some of the key Hong Kong stock, like for example, Hong Kong Exchange, Hong Kong Land, Sun Hong Kai, look at all these names. If you look at the stock prices, they have more or less bottomed and have slowly and steadily moved up. My view is this. After 7, 8 months of all this unrest, the market has more or less priced it in. The market have essentially moved on, right? So that's why I have it as a yellow, despite the fact that I don't think there's any resolution in sight for the Hong Kong situation. Next, US-China trade war and impeachment. So obviously, we are well aware that the phase 1 trade deal will be signed soon. So I think that's a good thing. So I have it as a yellow, and we'll talk about the trade war later on as well. And I think the other thing about impeachment and election. So why do I have that as an orange? Because I feel Trump's impeachment is actually a good thing for the market. The reason is this. Before he was impeached, he was enemies with everyone. He was fighting with everyone. But now that he's impeached, right, I don't think he can afford to fight so many wars. He has a domestic war that he has to fight, and externally, I think, in his mind, he has more or less decided that he's going to do a deal with China. I think the key decision that Trump has to make is this. Does he want to go down in history as the biggest China basher US has ever seen? Or does he want to go down in history as the best deal maker US has ever seen, right? So I think with the phase 1 trade deal, I think the path is clear. I think he wants to make a deal with China. But then obviously, he needs a boogeyman. So unfortunately, I think Iran is it, right? Which brings me to the other point. So this was done in June of 2019. I would love to say that I knew there was going to be a drone attack on the Iranian general, but I don't. But all I knew was that Iran was always going to be in the background, right? It's always brewing, and something is bound to happen. So once again, I think US-Iran tension will continue to simmer. But the good thing is we don't expect World War III to start. So if you look at the Twitter, right, the Iranian foreign minister, after the missiles went off and hit the Iraqi US base, he actually said that we have concluded a proportional response to the attack on the Iranian general. So from that, my view is that I think there needs to be a reaction from Iran, but fortunately, there's no overreaction. But having said that, there's always going to be that simmering in the background. And last but not least, we have Kim, right? So the situation with North Korea continues to persist. So I don't think that will go away soon. And the best part is, I think Kim is the only guy who can out-Trump Trump, right? It takes one to know another, right? So I think, once again, somehow, Kim gets to go along with his circus, and there's very little that Trump can do to prevent him from actually disarming himself. Okay, and all that actually bodes well for what is to come in 2020. This chart, I think, is very significant. You can see the uptick on my left. That part is like what I mentioned earlier. There was a significant loosening of the central bank balance sheet from October of last year. So not only did US decide to print money because of the repo tantrum, the ECB also started to print money from November onwards. I think that's significant because if you look at the chart, from 2017 onwards, the central bank balance sheet was actually contracting and was contracting at an alarming rate. But that has seen a reversal from the end of last year. So I think that will bode well for the market. With that change in the central bank balance sheet, we will expect to see more liquidity in the market, and that means that the market will probably do quite okay for 2020. And trade war. So obviously, we all know that trade war was a big issue in 2019. 2019 started off fine, and then in the May of 2019, the trade war restarted, and all hell broke loose all the way until October of last year. And then there was some form of resolution, and the market cheered that, right? And I expect that circus to actually carry it on. This one. So what we did for ourselves in RHB is we actually monitor the tweets of Trump, right? And we actually analyze what exactly is he saying about China. So you can see all the happy faces, the green bars with the Trump happy faces. That means that he's talking positive about China. You see the red bars with the unhappy face, that's when he's talking bad things about China. You can see quite clearly. From October onwards, it's green, green, green all the way, right? I hate to say it, but we do look at Twitter. The reason is because, right, nobody really knows what he's thinking. Nobody really knows what he's going to do, right? So the Twitter, unfortunately, is my little window into his psyche. So when he's alone at night with his Happy Meal and his smartphone, that's when he starts to tweet, right? And that's when the market starts to respond. I think it's important for us to take a look at what he's actually talking about on Twitter. That gives us insight on how he is viewing China. Right, on trade war. So right now we know that the phase 1 of the trade war, of the trade deal will be signed soon. Okay, our view was that when we heard that at the end of last year, we actually did this chart to help us understand what exactly is phase 1 trade deal and how significant is phase 1 trade deal relative to what everybody else was thinking. So I want you to focus on the red bar. The red bar was what Trump was threatening on Twitter in August and September of last year. He was essentially saying he's going to tariff on everything. All the 600 billion exports from China to the US, he's going to tariff on everything, right? Be it 15% or 30%. He's going to tariff on everything. And the market just went into a tailspin, right? And more significantly, is the last 160 billion that you see right there, right at the top of the red bar. And that's significant because that 160 billion essentially includes a lot of consumer goods, electronic consumer goods, your t-shirts, your washing machines, your TV, right? That 160 billion would have a profound impact on the wallets of the US consumer. So our analysis at the end of last year also indicate that I don't think he will push it through because the impact on the US consumer and his voter bank will be significant, right? So if you look at the trade deal, what is happening now is this. If this trade deal were to be signed in its current form tomorrow, the tariff decrease will be significant. If you look at the, first of all, relative to the threat that was banished about by Trump in the second and third quarter of last year versus what is currently playing out as we speak. 1st of September 2019, all this was at 25%, and this one, and the last 120 was at 15%. And that 120 will be brought down to 7.5%. So our view is this. This is a significant U-turn. Even though Trump doesn't say it out loud, China doesn't say it at all, because it's not in their interest to say anything at all. Our view is that there is a significant U-turn in the way Trump is dealing with China. So that's why when we heard this, when we did that analysis, we decided to turn more positive on China. So on this chart, for those of you who were here with me last year, this was a chart that I showed last year to actually explain why we thought that the last 160 billion, right, would not be tariff. So this is what we call a cost teardown. We essentially tore down the iPhone X that was retailing at US dollar $1,000, and we actually split up who makes what. So we can see quite clearly who makes the most money off of iPhone X. Obviously, Apple. Apple's gross margin was roughly about $580 per iPhone X. The rest of it, 420, is split between the cost of materials and all these guys here, plus the distributor who get 5% margin. So once again, we went back to this chart and we analyzed what exactly goes into making an iPhone. And more importantly, what role does China play in the iPhone X? You can see quite clearly. I put in all the charts there, all the flags there. You can see quite clearly that if you look at it, end of the day, China only accounts for about 10 to 12% of the cost of the iPhone X. 10 to 12% of the cost of iPhone X. And if you look at it, the basic manufacturing cost, that 2%, is essentially the assembly cost. That is what goes to Hong Hai, who employs all the young ladies and young men who puts the iPhone together, bit by bit, piece by piece, by hand. So those guys are getting 2% of the cost of the iPhone. And that if you remember, was the threat that Trump said he would bring iPhone X assembly back to the US. Do you think the Americans would do it for 2% of the cost of an iPhone X now? Right? So that's why with this analysis, our view was that there's very little chance that actually the last $160 billion would actually make its way from China to the US, because the value add that China actually contributes is actually very minimal. Think of it as like a Gap shirt, a Gap t-shirt, right? Who makes the most money? A Gap t-shirt costs $30, right? End of the day, with the GAP, who makes the most money is Gap. It's not the girls who sold the GAP on the t-shirt, right? So it makes no sense. So this year, we decided to use the same analysis to look at Huawei. Because Huawei was at the forefront of the US-China trade war and tech war. So on my right here, this is the Huawei P30 Pro. This retailed at US dollar $1,150, and that was launched in March of 2019. You can see quite clearly, I have highlighted here some of the key components, the technologically intensive components, and I've put in flags to let everyone know where do these parts come from, right? But if you fast forward 7 months, the Huawei Mate 30, this retails at US dollar $1,200. You can see quite clearly, a lot of these components have switched from American flags to China flags, right? And why is that significant? It's significant because all of a sudden, with one snap of his fingers, Trump changed the world. So previously, when I was investing for my funds, it was very difficult for me to buy Chinese companies because at the end of the day, they were assemblers, which was what I showed you earlier. They were just getting 2% of the material cost to assemble phones. So it's very hard for me to buy these companies because there's very little intellectual capital, there's very little knowledge involved. But with one snap of the finger, the world has changed. All of a sudden, right, for example, for my flagship RHB Big Cap China Fund, all of a sudden, I can buy a lot of these Chinese companies because they become a lot more interesting. All of a sudden, 20, 30 of these companies have to become technological leaders in their own right because they can no longer depend on the US for their components. So my view is this. I think Chinese history, 50 years from now, will look upon Trump kindly because I think they'll finally realize that Trump essentially helped them. Trump essentially woke the dragon up, right? And now it's quite clear, even on this chart alone, we can see the Chinese companies are catching up. And the best part is, this chart here is relatively new. These are just months in the making, right? My view is that this trend will continue on for the next 5 years, 10 years. Is a structural trends, right? So these are trends that I can buy for my company, for my stocks that I can put in the portfolio. So once again, Trump has changed the world. So on this chart here, what we have here is the US dollar versus the MSCI, which is an Asia benchmark. From this chart here, it's quite clear that the weaker the US dollar, the better it is for the Asian market. Like what I mentioned earlier, with the resolution of Brexit, with some form of a resolution of the US-China trade war, I think the risk in the market has gotten a lot less. So I think that's good for our parts of the world, especially if US dollar weaken as a result. So that means that for 2020, I think our part of the world will be quite okay. So on this chart here, we have this, our proprietary RHB Asia strategy heat map. So in essence, what I want to show you is this. So if you look at this T, T-1, T-2, essentially T-6 means 6 months from now. So in June of last year versus December of last year, you can see quite clearly that across all these metrics that we monitor, it's quite clear that things have gotten a lot better. From red to orange, it has become greener and greener. These are from widely available public data, right? We monitor that to assess what is happening to the world right now, right? So right now, there's only a few red or orange part. One is inflation. Inflation is something that we are looking at. And the other thing is also on valuation. So right now, over the last 2 months, in November and December, the markets have done very well. So valuation has gotten a bit more expensive. But having said that, it's not in the red zone right now. So we're still very comfortable going into 2020. But more importantly, I want to highlight here is this. As the year drags on, things have gotten a lot better, no matter using what metrics that you look at. Okay, next, something closer to home, right? This is Malaysia. I think there's 3 key things that is going very well for Malaysia. So the first one is the Malaysian Manufacturing Pmi. The Malaysian Manufacturing Pmi usually have a pretty strong correlation with the KLCI. So if you look at it, the Malaysian PMI has actually started to go into a positive territory over the last few months or so. So I think that is good for the KLCI. But right now, the KLCI is not reacting yet. But our view is that it's just a matter of time. So that's one. Second of all, Malaysian corporate earnings. I think Malaysian corporate earnings are starting to recover quite nicely going into 2020. So that will provide the extra tailwind that the market needs. But more importantly is this chart here. So this chart is just a simple PE chart of the KLCI. You can see quite clearly, KLCI is cheap. It's really cheap. Right? It's trading below its fundamental value as we speak. It's trading beyond 1 standard deviation. So in short, on the Malaysian market, our view is, I think KLCI is cheap, and we expect better performance in 2020 from corporate earnings, plus valuation, and also the overall macro picture. I think we can look forward to the ringgit strengthening over the course of 2020 as well, in line with the acceleration of growth, as well as broad-based US dollar weakness. So, and the other added bonus is that I think Bank Negara does have room to cut rates if we see further headwinds in the market. But having said that, I think all of us are well aware. I think domestic politics will continue to be a concern for the market as we speak, right? Okay, and the key themes for 2020, once again, I think 2020 is going to be a pretty good year, definitely better than 2019 due to these few key factors, namely global easing, de-escalation of the trade war, weaker US dollar, and therefore we look to overweight equities going to 2020, especially in Asia and China, right? And I think more importantly, I think for all of us here, I think the US-China trade war is headline grabbing, definitely, especially with Twitter, especially with the US election around the corner. But I think for all of us, I think we need to move beyond that. Huawei, you look at Huawei. Huawei was at the forefront of US-China trade war, and yet they have already moved on, right? I think we should move on as well. And like I said, I think the US-China trade war bodes well for China companies because they have moved up another level, and that will sustain them over the next few years and decades, right, as we speak, right? But having said that, I don't think that's clear skies all the way, because I think US election in the second half of this year, that will continue to be a concern, and we can look forward to more antics from Donald Trump. And also, I think what we need to worry about is also the geopolitical risk from Iran, from North Korea. So that continues to be hotspots that we have to monitor going into 2020. So with that, I've come to the end of my presentation. So I hope that the next time you see a banana, that will give you new perspective. And also, we'd like to thank everyone for the support that you have given to RHB. And we hope to help everyone navigate this duct tape banana world in the coming few years. Thank you very much, everyone. Thank you.